As usual, just going to start off with our disclaimer that trading involves the risk of loss of capital and it's not suitable for everyone. And I'm sure this is boring by now, but as I always say, I hope it is good for you. Many companies provide leverage, so just be aware you can lose substantially more than that initial investment that you make. Views, opinions, everything contained in this is purely for educational purposes, and it should not be considered advice. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital you're prepared, but most importantly, that you can afford to lose. Any doubts whatsoever, seek independent financial advice before risking your capital. Okay, so we're moving on to what happened last week. The FOMC minutes confirmed that the Fed is determined to beat inflation, although they are struggling because inflation data was stronger than expected, well, by most. CPI core to be expected had increased to 6.6, which was a beat because even though it was 6.4 before, people only expected it to come in 6.5, but 6.6, there it is, which again is just challenging, and it really does put the pressure on the Fed. Also, Michigan sentiment increased, and that was up to 59.8. So again, all of that is really positive data for the US. Jobless claims are slowly increasing, but let's not sort of put much emphasis on that because the job market is still really strong in the US. It's dropped down from its two jobs for every one person unemployed to about 1.65. And of course, when we see next month's data, that'll probably change again. Well, the UK, what can I say? I'm based in the UK. So, okay, first of all, unemployment hit record low of 3.5. Again, that worker demand is there. But GDP, negative. First quarter. So, if we get another one of them, we are technically in that recession. And of course, the UK is nowhere near as strong a economy as the US. Industrial production was also lower. So, again, manufacturing's down. So, we've just got to keep an eye on them. But, we're definitely, you can't compare any country, I don't think, at the moment. They're just a powerhouse all on their own. Of course, that will come to an end at some stage. But right, so let's carry on looking at the highlights from last week. So politics again. So the PM sacked the Chancellor after about 5 weeks, I think it was. Her job seems to be in danger too, as there's the potential for the Tory backstabbing to continue. That Boris was pushed out. Theresa May had to resign. What's wrong with the Tories? Why can't they actually get behind a leader? Why are they always trying to sort of push them out to sort of for their own gains, I reckon? But all they're doing is destroying the Tory party. So, when there is a next general election and, if they decide to get rid of Truss and bring in a new one, then I'm sure everybody is going to be screaming that they want a general election and that the Tories shouldn't carry on when they're on probably their fourth new prime minister since the last election, or third anyway. So with that in mind, it's just crazy what's been going on. So obviously you may have heard that she sacked her Chancellor, and I'm not sure what's going to happen. Is she going to survive? She's U-turned on, obviously, Chancellor. She's U-turning on the tax cuts that she was going to give. She's brought in a new Chancellor. We're going to just have to wait and see. But it does bring up some interesting data for this week coming. So In the markets themselves, I mean, we saw on Thursday one of those most incredible rallies in markets history. We'd seen some good, strong data, which is effectively negative for markets at the moment. But it just seemed, what caused that rally, and there's speculation over what that was, whether that was sort of maybe the Treasury, maybe the government, maybe the FOMC, who got involved in that, because it was a very strange, aggressive move. But to be honest, Friday brought everything back down to earth. Everything came back off again. So, it was a very short rally, shall we say. And of course, the IMF has cut growth forecasts again. China CPA 2.8% and PPI 0.9% year on year. When you look at that, most central banks, they would do deals, probably anything to get those types of numbers at the moment. But it's just not happening. And of course, there's the Chinese Party Congress going on at the moment, which is about re-electing and all the various things that they're sort of looking as to outline for going forward as well. Now, the stocks, when they dropped, one of them, the S&P, I think it was the S&P, I'll check that, that'll come up in the other data anyway, come down to sort of almost touch that 50 level. A lot of the others are sort of through different levels, but just keep an eye on the Fibonacci's on a lot of these, markets, because when they retrace, then that does give you that opportunity to sort of confirm that it is a retracement, and that 0.618 level, which is the golden ratio, is a major level. And it's one to really sort of, I'm very keen on that. I look at it because, if it starts to break that and close below that and continue below that, then in my mind, it goes from being a retracement to being a reversal. On top of that, we had a mixed week for the dollar, really. It's still so strong, and what's going to knock it? I can't see anything at the moment, personally. Oil rallied up to $93 last week before dropping back to 85. Really, probably on again this continued expectations for recession, but even OPEC plus forecast lower demand. And gold managed to rally back above 1700 only to fall again, and it closed the week around about 1650. So if we have a look at what's going on this week, then first thing is there's going to be more earnings coming out. So just keep an eye on them. Again, it's going to be pretty mixed, I reckon, depending on what sectors the companies are reporting from. In the US, we've got capacity utilization, industrial production, some housing data, Philly Fed manufacturing, and the Fed Beige Book. Now, I like the Fed Beige Book, and the reason I like that is because the central bankers, it's more sort of their opinions rather than just data crunching. They're not just looking at data going, this is what I think is going to happen, this is what I expect to happen. It's a little bit more personal than that for them. It's a little bit more about them, and each member from their own region contributes to the Beige Book, so it's definitely worth a look at. It comes out late in one of the evenings, but again, all of this sort of information you can readily get once it's been published just by going onto the central bank websites. It's all there for us. It's part of all this transparency that they give to us. Whether it's a good thing or a bad thing sometimes. It's probably good for us, maybe sometimes it's not so good for them. In the UK now, there's a gilt auction. Now, I wouldn't normally mention these or public sector borrowing to that sort of degree, but got to start keeping an eye on. If you're trading anything related to the UK, whether it's FTSE or cable, anything related to the UK, then be aware of this. We're much more sensitive to what's going on at the moment. So the gilt auction, because obviously the Bank of England went from a seller of gilts to a buyer of gilts, just to try and stabilise things for the pension funds. We're also going to see inflationary data coming out, CPI, PPI. We've also got retail sales, which is going to give us a little bit more insight into public spending. And of course, that public sector borrowing. Then on top of that, we've got the potential for more turmoil because the PM's reverse policies. Now, there's a big question coming up. Will the Tories unite behind her, or are they going to stab her in the back as well? Hopefully not, because, the UK just can't get going through this. You can't get rid of a prime minister just because they make a mistake. Otherwise, we'd be getting a new one every week. And that's probably a fact for most countries. So you've got to give her some time to sort of settle in and find herself, and then turn things around. Then, if that doesn't work, then it probably really is time for a general election and see what happens there. In the EU, we've got ZEW coming out, so that's just sentiment. Again, keep an eye on that. Housing and construction data. And then in China, GDP, industrial production, retail sales, housing, which is a key one at the moment because there's been a lot going on in China about the house markets, etc., property markets in general. And we've got the PBOC rate decision. And in Canada, we've got CPI and industrial production. So the macro outlook just continues. Geopolitics is driving a lot of it at the moment in one way or another. The situation continues to impact the markets. I mean, North Korea even fired more missiles. For me, that's just a little bit of attention seeking, but whether that's true or not, I don't know. Russian-Ukraine enters the 8th month now. It's amazing, isn't it? It's been going on for so long. Ukraine continues to regain some ground, but Russia started to bomb some of the major cities in retaliation because the bridge in Crimea was attacked. Now, UK government, again, I've got to come back to that, just remains in turmoil as our new Prime Minister sacked a chancellor. The guy had only been in the job for 5 or 6 weeks. How much independence each of these get, I don't know. I'm not really into politics. And his replacement actually was was a supporter of a challenger in the race to become PM. So that's going to be interesting to see. But as I keep saying, it's really now time for the Tories to unite behind a PM instead of keep backstabbing them. Otherwise, the public are going to be crying out for a general election. And that really, to be honest with you, could put the Tories out of power for maybe even 2 elections. Central banks. So central banks, there's meetings approaching. We're going to see more rate increases. They're just going to continue. And remember, these higher rates are going to remain with us through 2023 as far as I'm concerned. Now, on Tuesday, I am holding a webinar, and that's based on why central banks are driving economies into recession. I've added the link in there, and it's going to be worth a look at, especially if you're not that sort of knowledgeable when it comes to macro. So I'm happy to try and help where I can. So listen in. Otherwise, just reach out to me and ask me any questions that you may have. Inflation, stagflation, still with us. Inflation is so sticky at the moment. It's really not coming down as the central banks hoped it would. of course, they can only control the demand side, and they're not even getting control of that yet, especially in the US, because, there's just still so much money floating around in the system. And of course, household wealth is still higher than it was pre-COVID. Last time I looked, it was about $144 trillion. That was a few months ago, so it may have changed slightly with the stocks coming off. And all I can see is that, for me, the raw material costs are lower, and therefore, companies should be passing that on to the consumer. However, they've got higher labour costs, higher power costs, and the rest of it at the moment, I would say, is greed. They're holding on to that. They've got the best profit margins that they've had for decades. They're over 15%. And until they start to sort of give some of that savings to the consumer, you can't expect inflation to drop. And of course, as I said earlier, US CPI core was 6.6%. We always look at the core because it's the more stable of the data, because it takes out energy, it takes out food, it takes out alcohol and tobacco. I wonder if that includes e-cigarettes these days. Okay, right, let's be serious again. So recession, I just cannot see any other outcome. It's just a question of how deep it's going to be. I expect probably the US to be the last in recession, proper recession, a real recession. I'm not talking about a technical one because they're already there. And probably be the first out. That's just the way they are. They're such a strong nation. And emphasis on a real recession, because it's so easy to hit a technical recession. What is it? All it is 2 negative quarters of GDP, consecutive quarters. That is a recession. But does it really mean that everything's sort of hitting the worst case scenario? I would say not. However, you start to see unemployment rise, job offers disappear, and et cetera, then, that's the signs of a recession. And going forward, to be honest, I can't see any other way out of this inflation situation. Again, that's why I'm doing this webinar on Tuesday, because I see that as the only solution that central banks have got. Drive the economy into the ground, and then they can rebuild it once they see that inflation has come down. Now, again, when I say that, that doesn't mean that if they start to see, jobs cut, etc., they're not going to dive in quickly to rescue the economy. They're going to want 3 to 6 months of seeing inflation not just drop, but stay down there. They need to get this back down to sort of around their target 2%, and make sure it's going to be sticky around there, and not suddenly peak again, because otherwise they would have wasted everything that they've just done. We're still seeing a bit in the way of supply chain issues. They have improved, although COVID, you've got to get that back on your radar. I just made that up, sort of trading and radar, so I just chuck that in there. Don't blame me, but I did. Omicron, so it's mutated into many different versions. Now, the question's going to be, will any of them be more lethal as we start to enter winter? China still has lockdowns. There was even a small demonstration in the Shanghai district, and that sort of coincides with the China premiership elections going on as he goes for his 3rd term. Of course, Russia, as I mentioned earlier, with Ukraine, now 8 months. Ukraine gaining that ground. Russia bombing in retaliation for the bridge damage. Both sides probably getting short of weapons now, I would guess. But it is only a guess. Energy and food inflation. So they seem to be easing, but it's not being reflected in the data. You know, wages, power, greed. They're the things that I see within the companies at the moment that's impacting and making them keep prices up. You know, maybe they just want to sort of get as much profit in the bank as they can because they can see that that recession is going to sort of appear at some stage and probably not so far in the future. Job losses I expect as well.